So our lecture today, as I said, is titled Investing Strategies to Improve Your Results. And we're very privileged to have Larry Swedroe with us. Larry was one of the first authors to publish a book that explained the science of investing in layman's terms, our terms. And it was titled, The Only Guide to a Winning Investment Strategy You'll Ever Need. Now the thing I'm puzzled about is the title of that book says The Only Guide, and since then he's authored 7 more books, as well as co-authored another 6. But the bottom line is he has spent his time, talent, and energy educating investors just like us about evidence-based investing. He's a director of research for Buckingham Asset Management, a registered investment advisor firm in St. Louis, Missouri. He's also director of research for BAM Advisor Services, which is a service provider to investment advisors across the country, including Cypress Asset Management, which is the local firm that arranged for Larry to be here tonight. His dedication to helping others has made him a sought-after national speaker. He's made appearances on national television shows airing on NBC, CNBC, CNN, and Bloomberg Personal Finance. And he's a prolific writer, contributing to many outlets, including mutualfunds.com, ETF.com, and boggleheads.com. He holds an MBA in Finance and Investment from New York University. Larry is in Peoria tonight with the help of Mike Mahoney of Cypress Asset Management, who's here with us tonight. Would you wave? So, standing in the back of the room. Mike is a certified financial planner and managing principal of Cypress Asset Management. Many thanks to Mike for bringing Larry to Peoria and for providing the copies of Larry's book that are free to attendees tonight. So let's give him a round of applause. And if you're interested, business cards, both for Mike and for Larry, are on the table out there. So we welcome Larry back to Peoria. He spoke here in Peoria for OLLI in August 2011 on the topic of the quest for alpha, advice for prudent investing. And, Larry has asked us to hold questions to the end unless it's a clarification question, like you just don't understand the sentence you just said. But for the most part, hold your questions to the end, and there'll be lots of time. So let's give a warm OLLI welcome to Larry.
So there's a new arrival in hell, and the devil goes to greet him to make sure he's suitably miserable. And there's the person, he's got the big hammer slamming on rocks and chains all bound around him, but he's got a big smile on his face. So the devil goes up, very worried, this has never happened before, and he says, "What are you happy about?" He says, "Well, I grew up in Peoria, and the summers there are hot and miserable, and it just brings back these great childhood memories." And devil's very upset. He said, "I'll fix this guy." Goes back, turns the thermostat up a few more degrees, adds a few more degrees of humidity, comes back the next day, the guy's pouring even more sweat, but an even bigger smile on his face. He says, "Now what are you happy about?" He said, "Grandpa had a farm outside of town, and in the summers there I'd be shoveling that hay in the silo, and it just brings back those great memories." The devil is furious. He's stumped. He's never faced this before. He goes back to his office and he thinks for days. He's troubled. He can't figure out how he's going to make this guy miserable. So finally he gets the brilliant idea. He'll turn the thermostat the other way. It's now 30 degrees below zero, 30-mile-an-hour wind chill factor. And he goes back and the guy is shivering as he's pounding on the rocks, but an even bigger smile on his face. He says, "So now what are you happy about?" He says, "Well, I told you I grew up in Peoria. I'm a Cubs fan. If it's a cold day in hell, the Cubs must have won the World Series." And I'm a Cardinal fan, so. Anyway, tonight's lecture is based on this little short book I co-authored with Andy Birkin who is actually a scientist, and we're both fans of science fiction, so that's kind of the theme here. And because it's a little bit more technical than some of my other talks, I thought it'd be helpful to give you a couple of definitions that hopefully will be helpful as I go through the talk. And the first one is about this term here, alpha. So what does alpha mean? That's a term Wall Street loves to use. Our job is to generate alpha. So alpha is the performance above or below. So alpha can be positive or negative. So it's performance above or below an appropriate risk-adjusted benchmark. So what that means is if you buy stocks and outperform treasury bills, that's not alpha, right? You have taken a lot more risk. Treasury bills are not an appropriate benchmark for stocks. Now, maybe if you outperform, say, Vanguard's total stock market index fund, that might be alpha, okay? If you buy junk bonds and you outperform treasury bonds, that's not alpha. That's taking another type of risk called credit risk, okay? And each of these risks, by the way, are called betas. How much exposure I have to some factor or asset class. So stocks are riskier than bonds. There's a beta on the stock market that's telling you how much of your portfolio is exposed to the stock market risk. If you take credit risk, you have a beta on that factor of default. If you buy long-term bonds and outperform short-term bonds, that's not alpha, okay? If you buy small stocks and outperform large stocks, that's not alpha. What would alpha be then? If I bought 50, say, small stocks, because I thought or knew that those stocks would outperform, and I beat an index of small stocks, that would be alpha, okay? Everybody with me? So alpha, a simple way to think about this is the following. Alpha and beta. Beta is returns that can be explained by the market, whether it's the market for junk bonds, longer-term bonds, small stocks, or whatever. It's what the market in those asset classes, call them, is doing. Alpha is the performance that cannot be explained. So it could be positive or negative. Okay, everybody with me? All right, that's important because that's the whole nature of the talk. So 1998 happens to be a very key year. One for me because that was when my first book was published, The Only Guide You'll Ever Need to Winning Investment Strategy, but a much more successful book. Charles Ellis, who's very famous and deservedly so, wrote a wonderful book. I think it's probably in its 6th edition or something by now. I'd urge you all to read it, called Winning the Loser's Game, in which Ellis demonstrated in his book, providing the evidence, that while it certainly was possible to win the game of active management. And what do I mean by active management? I mean the art, call it, of picking stocks that will outperform an appropriate benchmark and or successfully timing the market, okay? So he said it's certainly possible to win that game, but that the odds of doing so are so poor, it's simply not prudent to try. Now, if you look in the mirror and you see Warren Buffett or Charlie Munger, go ahead and try. But the average person, and certainly the average institutional investor, should not be trying. And so he said, just like at the slot machines in the casinos in Vegas, the roulette wheels, or any of the games there, the way you win a loser's game, where it's possible to win, just like it's possible to win by buying a lottery ticket, but not likely, right? The way to win a loser's game is to not play, right? That's the surest way to win at the slot machines in Las Vegas is don't play. So what does that mean in terms of investing? It means avoiding the game of active management and being what is called a passive investor, just accepting the market returns in the asset classes you decide you're willing to take the risks of. And that means, in very broad, simple terms, use index funds. It doesn't mean just owning necessarily an S&P 500 fund. You can own a small cap index fund, an emerging market index fund, build a globally diversified portfolio. Okay? There are other types of funds that are passive that aren't index funds. They're In fact, none of the funds we use or Mike's firm uses are index funds, but they're all passive. We think they are just superior vehicles because there are some negatives of indexing which can be minimized or eliminated, and there are some positives which can be maximized. So here we have this battle of active investing that tries to generate alpha, and passive investing which accepts the fact that yes, it's possible, but unlikely to be a game that you're going to win. Okay? So now what I hope to do in the next 40 minutes or so is to present a compelling case using 4 big themes that demonstrate that while Charles Ellis was clearly right to call active management a loser's game, it's not that the people playing it are losers, right? It's the game that's possible to win but not likely. That he was certainly right to call active management a loser's game when he wrote his book now 17 years ago. But the evidence is compelling that it's gotten persistently harder and harder. So now the odds of winning are infinitesimally small, especially if you're investing money in taxable accounts. So my story begins really about 50 years ago when the introduction of the first formal asset pricing model. This was the beginning of the whole field or science of investing in the field of finance. There literally were no finance courses taught until pretty much the 1970s. Maybe you took a class that was part of an accounting program. I went through really the first group of finance classes because there was no theory about finance until 1965 or so, and the capital asset pricing model was developed. 4 gentlemen, William Sharpe, whose name you might know, he recently, or in 1990, won a Nobel Prize for his contributions. But he wasn't the only one. 3 other gentlemen, working all independently, came to the same conclusions. Fellows named John Littner, Jack Trainer, and Jay Mawson also contributed to the work. Now, the CAPM was a really important advancement because it gave us, for the first time, a way of thinking about risk and expected return. It gave us a definition. It also enabled us to explain now 2/3 of the differences in returns between portfolios using a single factor that they called beta. Now, I told you before you can have beta on many factors. Generally speaking, when people talk about beta, they mean the market beta. That means the risk of a security or a portfolio relative to the risk of the overall stock market. Okay? Now, just so you know, it doesn't mean your asset allocation. So you could be 100% stocks, but have a beta of a lot more than 1. 1 would be equal to the market risk. So how would you do that? All the stocks you own are high-flying tech stocks. Maybe they have a beta of 1.5. So if the market went up 10, you would expect to go up 15 or 50% more. On the other hand, if it went down 10, you'd expect to go down 15. You could also be 100% stocks and have a beta of maybe 0.6 or 7 because you buy what are called defensive stocks, things like drugstore chains or grocery store chains. They're not so volatile. Or you could be any combination. You could be 60% stocks, but they're all high-flying stocks. So beta is not your equity allocation. It's how much risk does your portfolio have relative to the market, okay? Got that? So how does your portfolio co-vary with the market returns? So a way to think about this is the following. This was a big advancement, as I said. If portfolio A over here has 100 stocks and it got 10%, portfolio B got 13, it owns 100 different stocks. Simply using my model and knowing what the beta of the 2 different portfolios was, I could explain 2/3 of that difference, or 2 of the 3% difference in returns, without even knowing what stocks they own. So that's telling me a lot about stock picking. Most of the difference in returns had nothing to do with what individual stocks you bought, but what their beta was. How did its risk co-vary with the market? I'll give you a little simpler definition if it's helpful. It's not exactly right, but generally speaking, you can think of beta as volatility. So a higher volatility portfolio has a higher beta. It's not exactly right. The correct definition would be volatility in the form of standard deviation times the covariance of returns. How does it move with the rest of the market? Okay? But you could think of it simply, if it's helpful for you, as volatility. Okay? So this was a big advancement. The problem was that there were big holes in the theory. In other words, there were anomalies that were coming up. In other words, the model was flawed or wrong. We only were able to explain 2/3 of the differences in return. There was a whole bunch of other stuff going on that the economists or financial economists could not explain. And over the next few decades, a bunch of papers were written digging into this area. 1981, along comes a fellow named Ralph Bands, and Bands writes a paper showing that small stocks outperform large stocks even after accounting for their higher beta. So they were riskier, they were more volatile, but even after they accounted for that, they still provided higher returns. Over the course of the rest of the decade, there were a bunch of papers came out that showed also that value stocks, you could think of them of stocks that have low prices relative to some metric. Might be earnings, cash flow, sales, dividends, doesn't matter. All those metrics show, if you have low prices, they are called value stocks. They found that this was also true. Okay? So we now have two more, you could think of them as systematic factors that explain returns. 1992, two professors, Ken French and Jean Fama. Fama, you may recognize that name. He just recently won a Nobel Prize a few years ago for his body of work on this subject. They write a paper, which I believe is still today the most cited paper in finance, called The Cross-Section of Stock Returns. And they formalize into a model these two factors, adding now a size factor and a value factor to the beta factor. Now, these are the premiums you got, and I'm going to get a little technical, it's not that important, but these are the annual average difference in returns, so you can't compound them. So this takes 88 years of data, looks at beta is the return, annual average return of the market, takes 88 years of data, adds up each year, subtracts from it what's called the risk-free rate, which is the return on treasury bills, takes that difference and divides it by 88, and 8.4% a premium. Fama and French called these risk premiums. In other words, you didn't get it every year, but it's compensation in terms of expected returns for taking greater risk. They also found the value premium. The difference in returns between value stocks and growth stocks was 5% a year. So for those of you who like to invest in growth stocks, you might keep this in mind. And then small stocks outperform large stocks by 3.4% a year. Now this was a huge advance in theory for several reasons. First, it increased our explanatory power from about 2/3 of those differences in returns. If you think of those two portfolios I mentioned earlier, the 10 and the 13, we were only able to explain 2 of the 3% difference. Now we're up to about 92%. Now think about what that does. That means that we can now explain about 2.75% of the 3% difference, and it has nothing to do with any stock picking skills. It's just which factors did you invest in? In other words, you buy an index of these stocks in there, and we can explain 2.75 of the 3% difference. It doesn't leave much room anymore for the ability to add value by individual stock picking or market timing. We're up to 92% or so. It also was another big advancement. Who would you say here, ladies and gentlemen, would you say is the greatest investor of our generation? Warren Buffett. What kind of stocks does he buy in this 3 triangle? Value stocks. So it was a big advancement here because we went a long way to explaining Warren Buffett's success. Not all the way, but a big chunk of his success was not individual stock picking. It's that he recognized 50 years or so before the academics figured it out, and Graham and Dodd wrote the original papers in the 1930s and were his mentors. Big chunk of his outperformance was because simply he bought value stocks. Now, I want you to think very carefully. This discovery, if you will, takes nothing away from the active managers who were exploiting these factors before it was published, right? They discovered the secret sauce before the academics did. In fact, maybe the academics figure out, hey, we ought to study the performance of the great managers to see if we can identify, is it some unique skill they have, or is it some systematic factor that we can replicate using a simple computer? And just tell us which stocks to buy. And they've identified these things. So the important message I want you to get here is what was once alpha prior to 1992, if you bought value stocks, you could legitimately call it alpha because the CAPM model didn't account for that. But after 1992, it's been converted into beta, or a systematic factor that every one of you can access in simple index funds. That funds like Vanguard today, and the ETFs, iShares, and the funds we use, families like Bridgeway and Dimensional Fund Advisors, AQR, as I mentioned, they find a way to enhance these indexes by a little bit, not huge amounts, but by enough to add extra value. So we've advanced the state of the art up to we can explain about 92% of the returns. The next big advancement only took 5 years. I'm sorry. I don't know. Oh, here we go. Okay. So 1997, a fellow named Mark Carhart comes along. He writes a doctoral dissertation showing that he had a fourth factor. He had built on the work of two researchers named Jagadish and Titman, and he found that securities that had outperformed over the last year have a tendency to continue to outperform for a short period, 4 to 5 months on average. Not all of them, but there's a tendency to do that. And look at the size of the momentum premium. It's actually bigger than beta premium. Now, one thing, a little thing, just so you know, momentum and trends are not the same thing. Trends are absolute, so everybody knows. Markets are going up or down, that's an absolute direction. Momentum, you can have stocks that are, every stock is going down, but the ones that go down the least would be called positive momentum. They're performing relatively better in the last year, and the stocks that are doing the worst would be the negative momentum stocks. Or if everything's going up, even though you're going up, if you're going up the least, you're negative momentum. So there's a difference here. Momentum is defined in this relative way. And they found that there was this big premium. And again, it's improved our explanatory power a few more percent into the mid-90s. And once again, alpha became beta. There are funds, many of them, all the funds we use have been incorporating momentum since about 2003. About 5 or 6 years after they could test the data to make sure it held up after expenses and trading costs, because these are pure indices which don't have costs involved. So they're all incorporating them, and you could buy ETFs, et cetera, that did this. Now again, I want to emphasize, this takes nothing away from the active managers who were prior to 1997 incorporating momentum into their strategies. But now you could no longer claim alpha by adopting these strategies. It was simply beta, which is good news for you because you can buy beta very cheap. It's a commodity because a computer can run the whole program basically. And so you pay much lower fees to run index funds than you pay to active managers. So society, in the form of investors, you get to invest in the way the smartest investors were investing, and you don't have to pay as much for it. The next big advance came 15 years later when a fellow named Robert Novi Marx did a paper. He advanced the state-of-the-art building on work by those two famous people I mentioned earlier, Fama and French, who in 2006 had written a paper And he added a little bit of extra work to it, and it's called the gross profitability premium. He said, if you look up in the balance sheet, not at net earnings, but at gross profitability, so gross margins, if you buy stocks that have high gross margins, they outperform, all else equal, stocks with low gross margins. And and by the way, that premium is about 30 basis points a month, or 3.7% a year. And by the way, you now added to the explanatory power a little bit more. And who do you think this news came as a big surprise to Warren Buffett? Or had he always been saying, I like to buy stocks that are safe, cheap, high quality, and generally big? Now, the big may be because he has so much money he needs to invest, he can't bother with small stocks, but certainly these three. So the academics quickly went back to work and have expanded on the profitability factor, and now there's something called a quality factor, and quality stocks have these characteristics. They have low earnings volatility, high margins, that's the gross profitability. They tend to have a high asset turnover. They're very efficient at using their capital. Don't have a lot of inventory sitting around for a long time. They have low debt. That's Buffett liked to buy safe companies. They have low operating margins, so don't buy things like airlines, lots of risk, especially if you load them up with debt. They have what's called low specific or idiosyncratic risk. They move more with the economy than have a unique risk. So this now has been expanded, as I said, to this quality factor. And now we have our ability to explain returns is into the high 90s, not leaving much room for. Now, what's really interesting about this was a huge advance. And we now have two papers, for those of you interested, and it's cited in the book you have. One is called Buffett's Alpha, and the other is called Betting Against Beta. And they both found, listen carefully, and I hope you don't take the wrong message, but I'll explain to make sure you don't. They found that once you accounted for these factors, Warren Buffett's outperformance, or his alpha, disappears. It's no longer statistically significant. Now, again, it's important to understand, this doesn't take anything away from Buffett's performance, right? He figured this stuff out 50 years before everybody else. But they showed that if you bought an index of these types of stocks, you would have earned the same returns, basically, as Buffett's public holdings that he bought inside of Berkshire Hathaway. Now, he does better because he has access to the cheap financing and the float from the insurance company, so you can't replicate that. But the actual performance of the stocks is virtually indistinguishable. Again, it takes nothing away from Buffett, and the good news is you can now invest this way. And all of our clients have been investing this way now, since all of these factors are incorporated by all the fund families we use. Now, just as there are factors in stocks, luckily we have the same type of factors that explain the vast majority of returns in bonds, only it's much simpler. We only need two factors here. One is called the term or maturity premium, risk for taking a premium for taking the risk of unexpected inflation. That's been about 2% a year, pretty rewarding. The default premium is a credit risk premium. That's defined, by the way, as the difference in return between treasuries and investment grade bonds. Remember, these are indexes, no expenses. It's only 30 basis points. You go buy a mutual fund, which you need to do. You don't need a mutual fund to buy treasuries because you don't need any diversification. There's no credit risk. You want to go buy investment grade bonds of companies, I'd urge you to buy a fund. They have trading costs and expenses. You got almost no premium. That's why we don't buy literally almost any, where we have direct control, any investment grade bonds. We tend to stick with CDs, basically, where you get much higher yields than treasuries. So those of you who are taking credit risk on corporate debt, here's the evidence. You have not been rewarded for it in 88 years. That's why we don't take that risk in general. So That leads me to the second theme. The first theme, I hope you got the message here. The academics, by studying the performance of the great investors, are able to identify systematic factors that everyone can access in a low-cost way. And that converts what was once alpha into beta. So active managers, these big sources of alpha, are gone. They can't claim alpha anymore. How can they charge you big fees if most of the sources have gone away? And we're able to explain all but a few percent of returns. Okay, second theme here is that it has its origin in William Sharpe's brilliant paper, The Arithmetic of Active Management. What I'm showing you here is that all stocks have to be owned by somebody. And Sharpe said this, okay, if the market gets 10%, and I own passive investors, and I own a Vanguard Total Stock Market Fund, before any expenses, trading costs and the expense ratio, what return must I get? There's only one number it can be, right? 10%. That means that in aggregate, since the sum of the parts have to equal the whole, if this gets 10% and that gets 10%, this too must get 10% before expenses. There's no other number it can be, right? Now, this doesn't mean that all active managers get 10%. It does mean that if some outperform and generate alpha, some must do what? They have to underperform, because the sum of the parts must equal oh. So if someone got 20%, maybe somebody got 0. But I also want to take this opportunity to teach you that most of what Wall Street tells you is a bunch of lies. And not just white lies, big lies. Because you hear this myth: active management may not work in large stocks, it's too efficient market. But in small stocks, it's inefficient. So now let's take a asset class called small stocks. Small stocks go up 10%. I own Vanguard's index fund. I get 10%. What must all active investors in aggregate get? 10%. Here's another myth. Active managers protect you in bear markets. I'm sure if I asked people to raise their hand if they believe that, I'd get a good percentage of the audience. That's nonsense. Can't be true. Simple. Market goes down 20%. My Vanguard Total Market Fund goes down 20. What has to happen here? Has to go down 20 in aggregate. Same thing in emerging markets. Wherever you look, the math is simple. Now, what the message is that I want you to get out of this is that for some group of active managers to outperform, they must have victims that they can exploit. Who are the sheep that are waiting to be sheared? Who are the suckers at the poker table that don't know it? So I want to do a little thought experiment. I'll ask you to help me. We'll start out, we got two groups of investors, individuals and institutions, and they compete in the market. Who are the sheep waiting to be sheared in that? Who do you think? Individuals. That's exactly right. That's what the research shows, in fact. Series of studies by Brad Barber, Terence O'Dean find that, listen to this and see if this ever happened to any of you. I'm sure it hasn't. But the stocks that individuals buy on average tend to go on to underperform after you buy them, and the stocks you sell go on to outperform after you sell them. Has that ever happened to anybody here? Now, that's logical because the person you're competing with does most of the trading of the institutions. They know more than you do, right? They have PhDs in finance and have access to high-speed computers. They're likely to beat you. But most people don't think about that, all right? So what I want you to understand is this. Here is the problem for the active managers. In 1945, you, individual investors, owned over 90% of all the stocks directly in your brokerage accounts. By 2000, the sheep herd is massive. When Warren Buffett's trading, 90% of the time he's competing against you, who's going to win? By 2008, that number was already down to 20%, and the trend is going like this. The sheep herd is shrinking. There are less victims to exploit. You need victims in order to generate alpha. But the story is much worse than this. Because on the institutional side today, already 40% of institutions have abandoned the game of active management. So I want you to do another little thought experiment with me. I want you to consider two groups of active institutional investors, ones that have been winning the game and the ones that have been losing. If they were winning the game, it could be skill or it might be luck, hard to know, but over time luck disappears and you join, if it was good luck, it disappears, and you join the losing group. The losing group could be bad luck or you're just sheep. You don't have the skills to win the game, right? Which group drops out of the game? The ones who are winning, do they keep playing or they drop out? Or is it the losers that drop out? What do you think? The losers drop out. If the losers drop out, what happens to the competition? Is it getting harder or easier? Much harder, harder and harder. Think about this, okay? Here's the analogy. I'm sorry I didn't think of it until after I finished and the book was published. But here's the best way to think about this. Okay? Novak Djokovic is the best tennis player in the world today. If he competes in a Grand Slam tournament in the first round, he's playing against somebody who's ranked 128th in the world or somewhere like that. Okay? He is clearly much better than them, even though they're a world-class player. There's only 127 better players in the world. Do you know that in the last 10 years, Djokovic has not even lost a single set in the first round of a Grand Slam tournament? Even though he's only that much better, he's enough better that he wins easily. Typically, the sets are over very quickly. He wins 6-0, 6-1, 6-2, something like that. As he advances in the tournament, maybe he's now got to the quarterfinals, what's happening? The competition has gotten tougher. He's now playing somebody who's ranked 16th in the world, maybe, or in that top 16, right? Competition, skill sets are getting closer together. What happens? He still wins almost all the time, but now he may even lose a set or two. And the matches are going maybe 2 or 3 hours. And then he gets to the finals, he's playing Federer and Nadal, or Murray, or Wawrinka, and now they're 5-set marathons often, 4 or 5 hours, and many tiebreakers, and he barely squeaks by, sometimes even losing. Still wins the majority. He is the best player in the world. So what's happening is think of it. That first round is like the world of investing in 1945, where 90% of the competition were people like you and me. By the time he gets to the finals, it's Warren Buffett competing against Peter Lynch. Hard to know who's going to win. As the losers drop out, the game gets harder and harder. The victims are getting much smarter because they're in terms of who's left to be a victim. And that brings us to the third theme, which is that the competition is getting tougher. So I want you to think about this. I told you I went through one of the first MBA in finance programs. So think about who the competition was running mutual funds 50 years ago. Okay? Today, almost everyone running mutual fund and institution and hedge fund money is a PhD in finance from one of the top MBA programs. They're armed with all this knowledge that I've given you, all the high-speed computers you can think of, right? And there are firms like Renaissance Technologies and SAC Capital, D.E. Shaw, names you may or may not have heard of, but they hire world-class scientists, physicists, mathematicians in an effort to cover a little bit of unknown alpha and squeak it out. Even the fund families we invest in, like Dimensional Fund Advisor or Invest With, their two co-CEOs or chief investment officers, Eduardo Repetto and Gerard O'Reilly, are both PhDs in science from Caltech. And they're running passive shops, but they need to be aware of all this evidence. Think about how much tougher the competition is getting. Right? That leads us to what's called the paradox of skill. And it applies to that tennis analogy. As the competition gets tougher, the skills are getting better and better, but it's harder and harder to generate performance that separates you from the crowd by very much. You could think of it, that's Djokovic's alpha, is shrinking his big alpha in the first round, tiny alpha in the last round. So I want to give you an analogy of that for you. Those of you who are sports fans, I think will find very helpful. Has to do with baseball. So for those who aren't baseball fans, you'll excuse me, but hopefully you'll get the point, and I'm going to relate it to investing. So the modern era in baseball begins in 1903. That became the modern era because before that, any ball that was hit foul and wasn't caught was not counted as a strike. Obviously, pitchers were at a much bigger disadvantage until then. So batting average were much higher. So all the statistics we see today really begin in '03. In the first 2 decades of the modern era, the magic 400 batting average mark was reached 4 times, so about once every 5 years. In the first 39 years, it was done 11 times or more than once every 4 years. But it hasn't been done in the National League since 1930 when Bill Terry, 85 years ago, barely did it, hitting .401. And it hasn't been done in the American League or baseball period now since 1941 when Ted Williams, going into the last day, was batting just under .400, and he went 6 for 8 in a doubleheader and ended up hitting .406. So I want you to think about this for a moment. How come, despite the fact that we have clearly today's athletes are far superior, they're bigger, stronger, quicker, have better training regimens, better diets, some would say even better pharmaceuticals, right? How come we don't have anyone hitting .400 in 74 years? And you can't say, although it seems logical, well, the pitchers are better, the fielders are better, the equipment's better. You know, the old gloves, if you look, didn't even have strings between the fingers. But that can't be the answer. And the reason is this. In the first 2 decades of the modern era, the sabermaticians, or the mathematicians who use math to look at sports, right? We now have a science of statistics in sports. For those of you who may have seen the movie Moneyball, that's what that was all about. What they found is the average batter in that first 2 decades, when it was done once every 5 years, hit between 250 and 260. And for the last 60 years, or 50 years or so, the average batter still hits between 250 and 260. So it can't be that we have better pitching or better defense or gloves or whatever. The batting averages are the same. It's this paradox of skill. Let me explain. If you look at the average batter in the first 2 decades, they hit 250 to 260, but the standard deviation of that batting average was in excess of 40. That meant, in simplistic terms, 2/3 of the batting averages were, let's say if we use 260, you would add 40, so up to 300, and you subtract 40, you'd be down to 220. So 1/3 of the returns were above 300 or below 220. About 3.5 standard deviations would get you to 400. That's very hard, but not impossible. So you had it done about once every 5 years. Today, that number has collapsed. The average standard deviation is down to about 25. So it's been cut 40%, more than 40%. So it's now a 6 standard deviation event almost. That's almost impossible. That's like the difference between an earthquake that's a 6 earthquake and one that's a 10. It's not just a little bit bigger, it's dramatically bigger. It's almost impossible. So as you get skill sets get closer and closer, like with Djokovic and Federer, it gets harder and harder to differentiate yourself. Okay? The same thing, by the way, has happened in basketball. When I grew up, Wilt Chamberlain dominated the backboards. He won the rebounding title every year. In fact, 11 years in a row, he got more than 25 rebounds a game. Today, if you lead the league with rebounds with 13, you're doing great. Getting half of what Chamberlain got. And clearly, today's athletes are much bigger, quicker, stronger. There's many guys who are 7'1" now, but Chamberlain was competing against an average center who may have been 6'8". He was so much better than them. Today, Chamberlain playing would still be a great player, but he wouldn't dominate the way. So there's this paradox of skill. And if we see this paradox of skill playing out in investing, meaning the competition's getting tougher, we should see evidence of that in falling standard deviations. And that's exactly what Michael Mauboussin found in his study. And he looked at large cap active managers and looked at their returns compared to the average. And he found the standard deviation when he started the study 40 odd years ago was about 13 here. If we draw a regression line here, because actually it was up here at 16. If you draw a line, you can see the trend. Okay, now you had a little blip, an interruption here. This is the internet bubble. So you get some people participating and look great, and obviously when it broke, you got killed. But you could see a very clear trend. Started out at 16, it's now down here to about 6. If you look at the trend line, it's 13 to about 6. So it's even collapsed more than the collapse in the standard deviation of batting averages. There was another study done that corroborates this. Hewitt Associates took a look at a study, and they broke the active management community into 3 categories. One is active managers which are generating no statistically significant alpha, either positive or negative. Now, if the markets are efficient, meaning that prices are pretty good estimates of the right price, you would expect most managers to have returns where alphas are pretty close to 0. So that means the market is explaining their returns with betas of their exposure to these systematic factors. And look, we see it wandering between about 70 and maybe 90%, ends the period at around 82. So most of the managers are falling here. Clearly, Ellis is right. 82% of them are just breaking even. Forget the losers. They're down here. That starts out at about 10 and has actually been drifting up a bit because the competition is getting tougher and they haven't figured out they need to drop out. Okay? People are stubborn. They keep trying to win. Okay? This is usually when I see the wives doing this to the husband. Right? But look at this. These are the group of active managers that were generating statistically significant alpha. So 1993 or so, this is probably about when Ellis and I are starting to write our books. I started writing in 94, 5. 20% maybe of active managers were generating statistically significant alpha. So 1 in 5 before taxes. So you had maybe somewhat of a reasonable chance, although obviously only 20% are winning, the rest shouldn't play, right? It's now down to 1.6% by the end of 2011. I would submit to you, the market, the trends are clearly getting tougher and tougher for the reasons I said. The ones who have been losing keep dropping out, the competition gets tougher. And this 1.6% is virtually identical to a study done by Fama and French called Luck versus Skill in mutual fund returns. They found evidence of skill in only the top 2 percentile of active managers. So that covers now 3 of our themes. The last one is that the supply of capital chasing alpha has grown dramatically. So we got the sources of alpha shrinking, competition getting tougher and tougher, and yet more money is being thrown at the shrinking supply. In the 1960s, so 50 years ago, there were, entering that period, I think there were less than 100 mutual funds. And the hedge fund industry was a nascent one. Very, very few of them. Today you have over 8,000 mutual funds and over 10,000 hedge funds. Think how lunatic that is, right? We only have about 4,000 stocks. Do we really need 8,000 mutual funds, right? Crazy. So a friend of mine, Bill Bernstein, decides, who's also author of some great books, he started to look at hedge fund returns. Okay, these geniuses, gurus, the superstars. And he looked at and studied the 15-year period, 98 through 12, and he broke it down into 5-year periods to see if there was any trend here. Now, in 1998, hedge funds only had about $300 billion of assets. So it wasn't that much money in the big scheme of things when you have a market of, say, 15 trillion or so. He found in the first 5 years, they were generating massive alpha. Remember, momentum had just been discovered just a few years before, value had just been published, etc. And what do you think happens when people show great returns? Everyone says, I want my share, and the money comes flying in. And of course, we showed you the competition's getting tougher, supply of alpha is shrinking, etc. The next 5 years, let's even be generous and say there's zero, because statistically different from zero it's the same number. But it's negative. And by the last 5 years of the period, and we're only up to 12, they were losing 4.5% a year. Now there is almost $3 trillion, and that's why it's negative. You got $300 billion and you're charging 2 and 20, maybe you can generate big returns, but when you got $3 trillion and the supply of capital is shrinking, supply of alpha is shrinking. Here's the returns to the HRFX Global Hedge Fund Index for the last 10 calendar years. Less than 1% a year. These geniuses underperformed every single equity asset class, even managed to underperform totally riskless, pretty much one-year treasuries and safe bonds. Any asset allocation would have outperformed them. And they're supposedly the smartest investors in the world. The market is becoming more and more difficult to beat. So now, here's the really important message. I want to make sure you're all listening. You need to keep what I've told you a secret. We need the active managers. They provide a very important societal benefit. It's their price discovery actions in trying to figure out what's the right price that keeps the market prices accurate, and that's what keeps capital allocated efficiently in the economy. You don't want a Soviet-style economy where somebody thinks they know and put money there. You want the market to be operating efficiently. So this is important. The problem is about $100 billion a year of your money is being spent to get those benefits. That's from a paper by Fama and French again. I don't think we need anywhere near 8,000 mutual funds and 10,000 hedge funds to keep the market efficient. Maybe 100 Warren Buffetts would keep the market pretty efficient. So maybe we could get away with 1/10 or 1/20 of that amount. So you all know what the right strategy hopefully is, but don't tell anybody else. All right, so let's see if we can summarize these hurdles here. We said that the pool of alpha has been shrinking as academics have converted alpha to beta. The pool of victims needed has been shrinking as people abandon the game. Every year that pool is shrinking as more people are reading books like mine and joining Boglehead groups and et cetera, and deciding that there is a better way to invest. They rather make themselves rich rather than Wall Street. Right? The competition's getting tougher and tougher. And these three trends, there is nothing that will stop them. They're as sure to continue as the sun is rising in the east. This one, we may have reached the tipping point. So that offers a little bit of hope out there, but not enough, I think, to offset these or even close. The amount of money assets has been growing, but now even some big institutional investors like CalPERS and some other European big pension plans have said, we've had enough, we've seen the evidence, it's compelling, we're abandoning active management, moving all of our assets to index funds. So that one may have some slight hope there. If the pool of money chasing alpha shrinks, then there's whatever little alpha is left may be a little easier. So what's all the good news here? One, the academics have converted the genius of investors in, so what was once alpha into beta. So every one of you can invest this way. Our clients have been investing this way and moving along with the science of investing for 20 years and benefiting from it. Every one of you can get on this train, and likely you'll be putting more money in your wallets and less in Wall Street by doing so. So that's the good news. Hopefully this has been helpful. Thank you very much. So We got some time for some questions. We'll take a few, and then I'll hang around and autograph any books. And some people may have a question they feel is too personal, so I'll hang around.
Thank you. I wondered if you could just comment briefly on the new trade possibility, that new agreement, how that's going to affect what you just said.
Okay. So the question was asked how this new Pacific trade agreement is going to affect. So I could give you a long answer, which is it won't affect it at all. That's all you need to know. But I'll give you a better answer, one that I think will help you for the rest of your life if you remember it. Swedroe's rule about investing, I got a whole slew of them. So one of them is this. Whenever you hear some information that you think is going to cause you to act, whether it causes you to buy stocks or sell them, GNP report, unemployment, Fed raising rates or not, whatever, or Bill Gross comes out today and says stocks are going to crash 10%, and he gives you all these reasons. So I'm going to tell you, a guy like Gross is smart. Maybe everything he said is logical and true, and you should totally ignore him because he has no clue what will happen. That's the first thing. That's the evidence. But the question you want to ask yourself before you ask is this simple one. It goes like this. I just heard this news on national television. I read it in the Wall Street Journal. I'm the only one who knows this. Does Warren Buffett not know this? Do the hedge funds? In other words, by the time you know it, it's already in prices. Whatever the news is, whatever impact it will have, good or bad, by the time you have heard it and are ready to act, you're way too late because the hedge funds certainly have hit the trade button and their trades will get executed before yours. That's the most important message you could get out of tonight. Whenever you're tempted to act, whether news is good or bad, just ask, am I the only one who knows it? The obvious answer, unless it's inside information, which is illegal to trade on, and Martha Stewart found out what happens if you get caught, all right? Don't act. That's the simple answer. And by the way, do you think Warren Buffett is acting on the trade news?
Well, the only thing I was thinking of, you have information here on the alpha, and it almost seems like, it's a pie that seems to be decreasing what size the pie is. And I was just wondering if this is, if anything at all, affects how much more.
Right, so the only thing I will say is this. The impact of the trade agreement, assuming it gets past our recalcitrant Congress, who should all be tarred and feathered on both sides here, but world trade should increase, GNP should be up, that should mean stocks should do better because growth will be faster, but I don't know whether it will get passed, and it's such the odds of it being passed are already incorporated into prices, so I don't act. But all trade pacts, free trade, the freer it is, the better it is. Everyone should always vote for these free trade pacts.
Thank you.
Other questions? Right over here.
Sure. The market fluctuates so much now. Is that due to computer trading or is that something else?
Okay, so the question was, the market fluctuates now so much. So first of all, there is zero evidence, sir, that the market is fluctuating any more than it ever did. What actually is happening is individual stocks are fluctuating more than they did. So that tells you, why am I buying individual stocks? I'm not getting compensated more, I'm taking more risk. But the stock market itself is not any more volatile than it's ever been before. That's just a myth. People have short memories. Stocks are no more volatile in the sense of the overall market than they've ever. In fact, the last 5 years were about as low a volatility as we've ever had. The average volatility of the market's about 20%. If you look at, you can go look up, Google the historical data on the VIX, which is a volatility index, and you can track it back daily, for the last, I think they've got a bunch of years. And you'll see it's been way under 20 for most of the period from 10 or 11 through now. Now, there have been some periods in 11 when we had the Greek crisis and blowing up where it jumped up. More recently, the last month or two, it's been in the mid-20s, maybe got to 30 or so. Last I looked, it was back down to the low 20s, so it's right about. But the last 6 years, I've been typically way below the historical average. So it's just another myth or perception because recency. You see, markets went up or down 1,000 points in a day. By the way, if you think that was a lot, if you remember 1987, the percentage drop was 23% in a day. Today, what would that make the Dow go down? 4,000 points? So the market is really no more volatile than it's ever been.
So Larry offered to stay behind and answer your individual questions and to autograph books. I think we'll let the people who have time constraints leave. And let's thank Larry for a great presentation.